than those expected for the investment's level of risk, i.e., it is difficult for investors to beat the market. An investor who pursues an investment strategy that seeks to beat the market must believe that the sector of the financial market to which the strategy is applied is not highly price efficient. Such a strategy seeking to beat the market is called an active strategy. Financial theory tells us that if a capital market is efficient, the optimal strategy is not an active strategy, but rather is a passive strategy that seeks to match the performance of the market. In finance, beating the market means outperforming the market by generating a return on investment beyond what is expected after adjusting for risk and transaction costs. To be able to quantitatively determine what is expected from an investment after adjusting for risk, it is necessary to formulate and empirically test theories about how assets are priced or, equivalently, valuing an asset to determine its fair value. The fundamental principle of valuation is that the value of any financial asset is the present value of the expected cash flows. Thus, the valuation of a financial asset involves estimating the expected cash flows, determining the appropriate interest rate or interest rates that should be used to discount the cash flows, and calculating the present value of the expected cash flows. For example, in valuing a stock, we often estimate future dividends and gauge the extent of uncertainty of these dividends. We use the basic mathematics of finance to compute the present value or discounted value of cash flows. In the process of this calculation of the present value or discounted value, we must use a suitable interest rate, which we will refer to as a discount rate. Capital market theory provides theories that guide investors in selecting the appropriate interest rate or interest rates. Financial management, sometimes called business finance or corporate finance, is the specialty area of finance concerned with financial introduction to finance, downloaded from www.worldscientific.com. by 110-39-243-196 on 04-27-23. Reuse and distribution is strictly not permitted, except for open access articles. 6. Introduction to finance. Decision-making within a business entity. Although financial management is often referred to as corporate finance, the principles of financial management also apply to other forms of business and to government entities. Financial managers are primarily concerned with investment decisions and financing decisions within organizations, whether that organization is a sole proprietorship, a partnership, a limited liability company, a corporation, or a governmental entity. Regarding investment decisions, financial managers are concerned with the use of funds in the buying, holding, or selling of all types of assets. Should a business purchase a new machine? Should a business introduce a new product line, sell the old production facility, acquire another business, build a manufacturing plant, maintain a higher level of inventory? Financing decisions are concerned with the procuring of funds that can be used for long-term investing and financing day-to-day operations. Should financial managers use profits raised through the company's revenues or distribute those profits to the owners? Should financial managers seek money from outside of the business? A company's operations and investments can be financed from outside the business by incurring debt, such as through bank loans or the sale of bonds, or by selling ownership interests. Because each method of financing obligates the business in different ways, financing decisions are extremely important. The financing decision also involves the dividend decision, which involves how much of a company's profit should be retained and how much to distribute to owners. A company's financial strategic plan is a framework for achieving its goal of maximizing owners' wealth. Implementing the strategic plan requires both long-term and short-term financial planning that brings together forecasts of the company's sales with financing and investment decision-making. Budgets are employed to manage the information used. In this planning, performance measures are used to evaluate progress toward the strategic goals. The capital structure of a company is the mixture of debt and equity that management elects to raise to finance the assets of the company. There are several economic theories about how the company should be financed and whether an optimal capital structure exists.